This one thing is keeping so many people poor. Recently, I came up with a 3 ETF portfolio that blows the old school 3 portfolio out of the water. It's not even close. The numbers don't lie. If you would have invested $10,000 in my 3 fund portfolio 10 years ago, you'd now have a little over $40,000. But if you'd invested instead that $10,000 into the old 3 fund portfolio, you wouldn't even have $20,000. Most people are enjoying the fruits of that solid new portfolio, but there are some doubters. And the number one issue that I'm hearing from these people is from something called fund overlap. When we talk about fund overlap, it's basically somebody saying that there's not enough diversification. So let's hear what the best investor of all time has to say about diversifying properly.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably.
And there he's talking about individual stocks, but it definitely holds true for ETFs. Why pick 10 or 20 ETFs just so you can own literally everything when anything outside the top 4 or 5 are just trash anyways?
And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness.
Or why pick options that will diversify your portfolio as much as possible, but it's also going to lower your returns? If one understands what they're investing in and why, then why not pick the best 3 or 4 options available? Fund overlap is when you invest in 2 ETFs and a certain amount of companies are actually represented within both ETFs. So essentially, you may think that you're more diversified because you have 2 ETFs rather than just 1, but actually you're investing kind of in the same exact thing, just in 2 different areas. If you think you're diversifying and actually making yourself safer, what might happen is that you're actually putting yourself at a little more risk. The way to check on this and do your own research is to look up etfrc.com. And so here we can look at 2 amazing funds like VTI, which is the total US stock market, and then VOO, or the S&P 500. Many of you ask me which one of those 2 is better, and I usually reply just saying just pick one because their return is fairly similar. VOO is slightly outperformed over the last 10 years, but it's very close. Looking at the fund overlap tool on ETFRC, we can see that there's an 85% fund overlap between these 2. 99% of VOO's holdings are in VTI. And this will pretty much be the case for any of these large market cap weighted funds. Even though VOO only has about 500 companies and VTI has close to 4,000, the funds are built in a way where the largest companies that we actually have in the United States make up the largest portion of that fund. So like Apple is a multi-trillion-dollar company, so the weighting of it in the fund is much higher than something like PayPal. So something like VB, which is Vanguard's small cap ETF, would be a fund that has companies that are much smaller than something in VOO or VTI. And so if we were going to look at the fund overlap between VOO and VB, you'll see that it only comes out to 2%. And this doesn't mean that it's better or worse than any other combination. It just lets you know that there's only an overlap of 2%. You see, the old 3 fund portfolio was made so that it gives the investor the most optimal advantage to be as diversified as humanly possible. You had 1 part US stocks and something like VTI or VOO. You had 1 part international stocks like VXUS, and then 1 part bonds. All of those are different with the idea that if the US stock portion were to drop, maybe the other 2 would hold it up and level everything out. If we look at the fund overlap between VOO and VXUS, it's literally 0 because none of the same companies are in each other's funds. Logically, this makes a lot of sense. But as investors, the trophy doesn't go to the one who's the most diversified. It goes to the one with the highest return for the longest period of time. It's been proven left and right that bonds are just not an investment that anyone under 60 should touch. Not because they're bad, but because you can just get such a better return with your money elsewhere. Same thing with international only ETFs or like emerging market ETFs. The return just isn't there. The logic is there as far as thinking that there's just untapped potential and growth out in these other markets outside of the United States, because within the United States it's pretty saturated and we already know what our growth is. And yes, there is way more growth potential outside of the United States. The only problem is it's not these international companies that are the ones that are actually gaining that market share throughout the world. It's these big Fortune 500 US companies through globalization and all the technology that we have that makes it so easy for us to cross borders. It's almost like borders aren't even there. Since these US companies are so big and have had such a big head start, they have the strongest technology, employees, and incentive structure to dominate. The fact is that 20 years ago, we could silo each country on its own and say that there's a growth potential within that country, so we should invest in companies within that country. But that's just not the case anymore. I have students who make sales to people in India from the comfort of their dorm room using companies like Amazon. And so with technology like that stealing business and market share from local companies within that country's market, my bet is still on large cap American companies to continue doing what they've been doing. So how is fund overlap keeping people poor? If you look at my new 3-fund portfolio, you're gonna see that there's a fair amount of fund overlap, specifically between VU and SCHG, or most any other broad growth ETF with VU. Between VU and SCHD, though, the fund overlap is quite low at only 12%. But for the doubters, they're gonna say that there's just too much fund overlap, it's all American companies, and they just wanna have that exposure to international funds or bond funds. And to those investors, I say, great, go for it. Each investor should invest based off of his or her goals and needs. As long as you fully 100% understand what you're investing in and you do the research and it's something that you feel is right for you, then I'm all for it. But if you are gonna pick this route and just diversify just for diversification's sake, just expect your overall returns to be a little bit lower. And if you can't get it in your mind to just pick a couple ETFs and you constantly worry that what you're picking isn't the best or which one will be the absolute best based off of like 0.01% or something, so you stay up all night comparing data and stressing out over which one's gonna be best, you're probably just gonna go mad. Fund overlap is keeping people poor because it's leading to analysis paralysis and overcomplicating things in your brain, so it actually leads to you picking nothing and investing in nothing as you wait to try to find the best thing. Keep it simple. My 3-fund portfolio is built with one thing in mind, and that's total return long term. Warren Buffett has said multiple times that he wouldn't bet against America, and many retirees that I know invested in just the S&P 500 for the bulk of their career, and they're retired happily right now, just investing in those American companies, and that was diversified enough for them. In this video, I give my prediction for what I think the price of the S&P 500 is gonna be by 2030. And in this video, I dive deeper into that 3-fund portfolio that I was talking about throughout this video. Watch one or both now and let me know what you think.